G'day, my name's Robert Gowdy and welcome to this week's video. This week we're going to have a quick look at some of the dodgy advice that I'm seeing, and I've got a bit of feedback from one of my clients and a bit of information I can show you as to what does happen out in the marketplace. But before we get on to that, for those that haven't subscribed to the channel, please do. Hopefully you can get some value out of that, and those that have been following us and subscribing, thank you very much for your support. So this week, or over the last couple of weeks, I received a document from an existing client who was cold called by a financial advisor firm based in on the Gold Coast. Now, essentially what they've done is they've gone in and said, right, what superannuation have you got? And then recommended essentially to roll the majority of that over into their preferred product and then charge the fees. Now, really, one of the main points that's always been obviously embedded in the way that we give advice, and I've got no doubt that 90% of the advising community do, is, and there is a legal requirement that we have to put our clients' interests before our own. So there's got to be value. There's got to be a win-win for any client to seek, to get financial advice. You can't be someone gets screwed over. Business will never get done that way. So we've got to look after our clients, put their interests before our own, and we've also got to make sure that we add value. If we don't add value, then obviously there's no purpose in what we do. And value can be perceived in a number of different ways. People sleep better knowing their money's looked after. There can be a financial benefit, which is obviously what most people are chasing. So if we just go to the screen now, we can have a look at this is just some screenshots that I took out of the statement of advice that was emailed down to my client. And this person's a nurse, so here in Victoria there's often First State Super is one of the go-to industry funds for the health profession. Hester is one of the other ones, and you can see here that the current fund at $62,000, it's a growth fund, so there's around around 80% in growth assets, and defensive assets of 30%. So that varies a little bit. So growth can mean a lot of different things, but they're essentially saying you've got 70% in growth and then 30% in defensive assets. And here they have the risk profile that the client has actually come back as a growth investor, so their First State Super is absolutely in line with what their risk profile is. So you'd think there wouldn't be much to be changed there. But of course there's no business gets done unless they get to recommend a product and do something. So of course they've then recommended a product, and what they've done is they've compared the investment management fee in the First State Super, the administration fees, to the alternative. And in bold down here we can see that the recommended fund is cheaper than the current superannuation. So that's a bonus, so no real issues there at all from what we can see. And then we get into some projections that are over very much a long term, around 20 years. So all of a sudden she's gone from growth. They've recommended a higher growth option, so they've essentially said, like, let's take on more risk. She's already in a growth fund. They're now, say, winding it up to a high growth fund, which essentially means you're being exposed, instead of say 70% growth, it's going to be 95% growth. So that means that there's more volatility, which if the client understands and is comfortable with that is fine. Now, what they've done here, over very much a long term, the growth where they currently are, the projected rate, 7.5, and the high growth will add an extra 1% to that, and that's exactly what they've done. And over the long term plus contributions, you can see, and this was the key selling point, that you will be nearly $44,000 better off when you hit age 67. Now, so that all looks pretty reasonable, and obviously is a huge selling point. Long-term projections are often dangerous, particularly when it's just used as a pure sales technique, and that's what I believe is happening here. Now, the bit that's the cruncher, the bit that I don't like, is obviously the cost. Now, they have put up here the initial fee. You can see the $3,300 for putting this advice document together and the work required to do that. But when we, and that's disclosed here, so that's 5.25% of the fund. But what isn't disclosed or taken into account in those projections is the annual advice fee, which is getting close to $1,400 per year, or it represents nearly 2.2% of the fund. So when we look at the what's been taken into account here, the fees, they've essentially ignored another $1,400 worth of these ongoing fees that's going to cost the client. So I can absolutely 100% guarantee that this client has their needs and best interests have not been put first. They will not win. They will only lose money out of this transaction. So what amazes me is this has come after the Royal Commission, where this is all about providing, putting our clients first, providing the good service, and this is just, sausage factory, one size fits all advice. So really disappointing after the year we've just had since the Royal Commission kicked off and the findings of the Royal Commission that this stuff still happens. So very frustrating, but for yourselves, please be very aware of this. There's got to be very legitimate reasons to roll from one fund to the next, and one of those, one of the key points is it's got to add value. It's got to be cheaper. Hope this was of value to you. Subscribe to the channel if you get a chance. That'd be great. And thank you for support and watching. We'll catch you next week.